Okay. All right. So up until this point, let's just make sure we're all good, because here's the big thing. Notice that I told you, it's like if you gave me some really good effort on chapters 1 through 4, we started off with the financial statements, right? We looked at the end product, what was on them, where everything goes, what were the equations of the financial statements, etc. Then in chapters 2 and 3, we looked at all the different daily journal entries that we have going on a daily basis in the accounting department. Then in chapter 4, we're basically at the end of a month, end of a year, end of a quarter, and we're looking at, things like prepaid rent. Have we used any of that? Prepaid insurance. Have we used any of that? Have we earned any of that deferred revenue? All those kinds of things. Have we sent people out, but to work at somebody's business, but we haven't billed them yet, but we actually earn that revenue, so we get to record that as well. Same thing on the expense side. Have we incurred an expense that we simply haven't been billed for yet? Okay, so that's what was going on in chapter 4 with adjusting journal entries. Most of the time, I think you guys get adjusting journal entries pretty well. The big one that you typically have challenges with is that concept of a closing entry. Just remember, a closing entry happens at the end of every year, where we are zeroing out revenues, expenses, and dividends so we can start new and fresh for the new year. Okay? And we're just simply updating the retained earnings balance for those revenues, expenses, and dividends. Okay? At the end of chapter 4, we were at the end of the entire accounting cycle. Okay? There's really not much more that we can add there. All right? Then, in chapter 5, we talked about internal controls. Don't miss that one. The lecture is probably the best place to get more insight on the internal controls piece. So make sure you go out to the lecture videos and take a look at those. And I think I actually posted that as a separate link on Brightspace last week, because somebody was asking about that. So make sure that you got that whole thing about internal controls from chapter 5. And then the other things in chapter 5 were petty cash. We did bank reconciliations. There was a third thing that just fell right out of my head. And I don't think it's coming back. So 5 was a lot about cash. Oh, we talked about cash and cash equivalents, restricted cash, all those kinds of things. So make sure that you're clear on all those different categories of cash. Okay? All right. In chapter 6, just realize once we hit chapter 4, we were done with the whole entire accounting cycle. Then we started at the top of the balance sheet and we started looking at cash. Now we're just simply moving a little bit down on the asset side of the balance sheet, and we're getting into this concept of inventory and what we do with it. So now, up through this point, we all assumed that we were dealing with usually service businesses. Okay, so when we made a sale, there was one journal entry, we recorded the revenue, and we either collected cash or recorded the accounts receivable. Okay. In chapter 6, now try to get the picture going in your head that we are a company and we are a store at the mall. We buy a finished product, we put it on the shelf. Our part of this whole supply chain is that we're getting it to the end user to be able to purchase the item and take it home with them. Okay? So we're not adding anything additional to it. No additional labor. We're just simply taking it out of the box, putting it on the shelf. Customer comes in, buys it, and leaves the store with the finished good. Okay, so that's important to really get your head wrapped around here. Now, the other big thing that we're going to look at because of all of this is we're going to look at the multi-step income statement. Okay, so we've already kind of hit on this one a little bit. Distinguish between service and merchandising businesses. So again, remember, when we're selling services, so just realize that the cost of selling the services, there is a cost, Just because there's one journal entry doesn't mean that there's not a cost to it, right? Somebody's time is involved there, but just realize it's being run through payroll under labor, okay, expense. When we're in these merchandising businesses, we've got two things going on. We've got revenues. We've got that collection side of the revenues. And then we've also got the inventory side where we're moving inventory, we're bringing inventory in, and then the customer is leaving with that inventory. So we've got two different journal entries there. Listen to me on this one, because here, this is a big one, okay? You cannot combine those two journal entries. Somebody's going to want to try. I'm going to remind you of this moment. There's two journal entries. They cannot be combined together, okay? So when we're looking at something like a service company, right, when we're out here on the balance sheet, right, we might have supplies. So again, we might have pens and pencils and paper and toner ink and whatever else in supply closet, and we might be consuming those things while we are providing the services, but understand this is not why we're in business of consuming those supplies. And they are literally being consumed, right? We crank down that pencil, we use up that pencil lead, we use that pen ink, right? It actually is depleted during the whole entire process of using it, okay? But when we're over here on something like a merchandising company side, and they use Walmart as an example here, is that we've got inventory that is sitting on the shelf that is waiting for the customer to come in. And that is our primary business of bringing the product to the customer and reselling it for a profit. Okay? So there you've got your inventory sitting out there on the balance sheet. Okay? Over here on going back to the service business, we've got one item out here that says service revenue. Okay? And then over here on the Walmart side, now look at what happens here. We actually change up just the top piece of the income statement by recording the revenue from the sale of the product. That's it. No other revenue goes in there. Okay? And then we're going to put in there the cost of goods sold. So that is the cost of that shirt, that dress, that skirt, whatever it might be, okay, that you originally bought it for, okay? So in this particular case, when we get to revenue minus cost of goods sold gets to gross profit, what this gross profit number tells you, and that's going to be the focus of this chapter for your ratio, is we're going to look at gross profit percentage. So what it tells you is how much after the sale of the product do we have to spend on what we call overhead kind of things, like the accounting department, the sales department, other things like that. Yes? It's how much the inventory cost that we sold. So the cost of goods sold. So let's say, for instance, let's just take it one item at a time. If we bought, let's say we're Belk, we bought a Tommy Hilfiger shirt for $30. From Tommy Hilfiger, okay? That $30 comes into the inventory account, and when the customer comes in and picks up that shirt and then pays us $80 for it, okay, we now show $80 in revenue. We move that $30 out of inventory into cost of goods sold, and we now have gross profit of $50 for that one shirt. The only difference is that here we're just using thousands and millions and possibly billions of inventory items on this financial statement. How are we doing there? Okay. All right. All right, so differences between periodic and perpetual inventory systems. Let me give you two pictures here. All right, perpetual inventory systems. Think computerized systems. You guys interact with these things all the time. Think you're standing there at checking out at Harris Teeter, Walmart, wherever it is, and they are taking that item and they're scanning the UPC code on the back of that item, and you're hearing beep, 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 as each item is scanned and leaves the store with you, okay? Think computerized. So perpetual inventory systems means it perpetually tracks inventory. So technically, we buy inventory, so in a perfect world, it should always work like this. If we buy 10 shirts, right, we bring them into the inventory system, then somebody checks out with 3 shirts, beep, 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 right? Then we should be able to go into the inventory system immediately and see that we should have 7 shirts left. You with me? Okay, that's what we're talking about there. On a periodic inventory system, try to get this picture in your head of the picture that always comes to me is like the flea market or one of those vegetable stands, something like that, where all they're really doing all day long is maybe weighing potatoes and saying, okay, X number of pounds of potatoes times X cents per pound, and it's like, you owe me $5, okay? Or, you know, number of pounds of carrots, or number of quarts of peppers, or, you know, number of bunches of flowers, right? Okay? That's the kind of thing that we're thinking about there, because all day long they're not worried about, they're not actually recording anything that has to do with the actual movement of the inventory. We're focusing on the actual revenue side of everything, and maybe at the end of the week we look at it and go, okay, well, we bought 100 bunches of flowers, and at the end of the week we have 10 bunches of flowers left, so we must have sold 90 bunches of flowers. You with me? Okay? That is a periodic type system, because all day long we're just worried about the revenue side of all the transactions and everything. All right? So, 3 accounts. We've got revenue, and then we've got the movement of the inventory. Okay? So, it starts off in inventory when we buy it and put it on the shelf. Then, as it's sold, we record the revenue. Then we record the movement of the cost of that inventory, okay, into cost of goods sold. And again, that equals gross profit. Now, one important thing to really pay attention to here is that gross profit is a calculated number on the income statement. It is not a number that you will see within the accounting records. So remember, the accounting records are tracking the raw data, which is total sales revenue and total cost of goods sold. It's not tracking gross profit. We get gross profit by subtracting cost of goods sold from sales revenue. Okay? So don't miss that. That's the reason why somebody always wants to try to make those 2 journal entries into one. Okay? All right? Let's look at a visual here. All right? So I'm going to refer back to this slide constantly, okay? Right? It just looks like a cross here, okay? So think of beginning inventory. That's what's on the shelf, okay? That's what we started with at the beginning of the month. The purchases are the items that we added to the shelf, okay? Which gives us what we call goods available for sale. So if we started in this example with $4,800 worth of inventory, we purchased another 10 too, then at some time during the month, we had $15,000 of goods available to be sold. You with me? Okay. Now, at the end of the month, there's only 2 places that goods available for sale can be. One is either sitting in ending inventory, which is what is on the shelf, or it's gone. You with me? So, in this cost of goods sold, everything that's not on the shelf is going into cost of goods sold. So, notice what happens there. When you take beginning inventory plus purchases, that builds your entire goods available for sale, and then goods available for sale then gets broken out between 2 items, ending inventory, or cost of goods sold, at the end. Okay? So everything has to add back to goods available for sale. All right? How we doing? Okay. Now, here they're just showing this in mathematical order. Just don't let this throw you off. This looks like two different equations. It is not. Okay? Because here, when we're sitting there and we're looking at this one, let me take the bottom one first. When we're looking at the bottom one, all we're doing is we're taking beginning inventory plus purchases equals goods available. Now notice, on both of these equations, it's the exact same thing. Okay? The only difference is that in a perpetual inventory system, where again, think computerized, we are tracking cost of goods sold because we know how many items are leaving the store at the checkout. You with me? Okay? So then what that defaults to is that when we're tracking goods available, then, or excuse me, cost of goods sold, then we know we should be able to go back into the system and actually see ending inventory. Okay? Up here at the top, that's more like periodic inventory calculation, because in periodic inventory calculation, we're not counting goods, cost of goods sold. We're simply going to the shelf and saying, okay, well, at the end of the day, we had X pounds of potatoes, X quarts of peppers, X bunches of flowers. You with me? Like from the farmer's market. Okay? And so we focus on looking at and counting ending inventory, and we back into cost of goods sold. So those two systems should, on a perfect day, give you the exact same results no matter what is happening there if we're using them side by side. Okay? But it's not a different calculation. It's just simply a little bit of algebraic work, right? We're both starting with goods available of 15,000. Up here, we walked to the shelf and went, there was $6,000 worth of ending inventory left on the shelf. Therefore, cost of goods sold must be $9,000. Down here, we go to our computer system and it says cost of goods sold is $9,000. Therefore, ending inventory, or what's on the shelf, should be $6,000. Okay? That'll just take a little bit of practice. Okay? So periodic. All right? So again, a lot of words, but don't let it wig you out. So again, the big thing is that in periodic, we're calculating ending inventory to get to cost of goods sold. Okay? Perpetual inventory, again, think computerized. So we are tracking cost of goods sold and can calculate ending inventory. Now, here's the big difference between the two. So think about this one. If we're at the farmer's market and we come in and we dump 50 pounds of potatoes onto the bin, onto the shelf or the bin, right? And at the end of the day, we come back to the bin and we've got 10 pounds of potatoes left. You with me? How many pounds of potatoes do we sell? Do we know absolutely 100% sure that we sold 40? Okay, so if it wasn't sold, what happened to it? Bingo. You with us? So it's like, we dump those 50 pounds of potatoes out. All we know is that at the end of the day, there was 10 left. Some of it could have gotten sold. Some of it could, people could have walked by, picked it up, stuck it in the pocket, and kept walking. We don't know. So that's what we're looking at over here on the left-hand side where it says we can't estimate shrinkage. Okay? So when we're talking about that kind of environment, and again, think farmer's market kind of thing, we can't estimate shrinkage. But if we're over here under a perpetual inventory system, somebody mentioned working at Target last time, right? Target actually uses a perpetual inventory system. They can see how much went in, how much left the store through the cash registers, but they can see how much left by just disappearing. Because if they put 50 pounds of potatoes on the shelf, somebody is going to check out with X number of pounds of potatoes, and if somebody comes by and just grabs one, sticks it in their pocket, and walks out the door with it, then when they go back to the shelf, they're expecting 10 pounds of potatoes, but maybe they only have 8. So now 2 pounds of potatoes have disappeared, and we don't know where it went. Okay? But again, remember, in the accounting world, we can't recreate the potatoes. We have to make the accounting system match what is in the real world. Okay? Any questions on that? Okay. All right, so we're going to analyze some purchase transactions under perpetual inventory system. Now, let me give you a picture here. We're going to kick into some high gear here, and you cannot lose your context. Okay? So right now, try to picture the fact that it's like we are something like Belk, and we are buying those shirts from Tommy Hilfiger. You with me? We're buying inventory, not selling it. We'll get to the sale part in here in just a minute. So, other things to keep in mind when we're looking at inventory purchases. So, we're going to look at the accounting for inventory purchases as well as transportation costs, purchase returns and allowances, and purchase discounts. All right, now let's get a picture going in our head here. Again, we're buying those shirts, okay, from Tommy Hilfiger. We can't get those shirts to the customer unless we pay somebody to transport them from Tommy Hilfiger's warehouse to our store. You with me? So just because Tommy Hilfiger maybe charges us, I don't know, I think I said $30 before. Let's say Tommy Hilfiger actually charges us $25 per shirt, but it costs us $5 per shirt for the transportation. That's a little out of whack, but you get the idea, right? We're still up to $30 of a cost per shirt, but now it's just divided between multiple things. 1, the cost of the shirt, and 2, the transportation to get it to us. So that transportation cost that's coming in, bringing our inventory to us, is part of the cost of inventory. You with me? Okay. Then we're going to look at purchase returns and allowances. So sometimes, I don't know, maybe Tommy Hilfiger sent us some shirts. We ordered them, and we wanted them in a certain blue, and when they got to our store, we're like, well, that's not going to work because we wanted to put them on all these displays and mannequins and everything else, and what we were going to put them with doesn't match that blue. So we send those shirts back. You with me? Okay? So that's the purchase returns and allowances. Okay? Now, that's a return. An allowance would be something along the lines of, we call, shirts came in, they were the wrong blue, but we're like, okay, maybe they won't work for exactly what we thought we were going to use them for, but we're willing to keep these. We think our customers would buy these, even though it's a different color blue. But we call Tommy Hilfiger and we go, y'all sent us the wrong thing. We're going to want, like, I don't know, $1 or $2 off, per shirt if we're going to keep these, because it's going to take us a little bit of extra work to get these things sold. That's an allowance. Okay. And then we're looking at purchase discounts. Now, purchase discounts, that's a situation where we buy the shirt from Tommy Hilfiger and we say, hey, we've got lots of excess cash, and if we pay you in 10 days, will you knock a little bit off of how much we have to send you? And they said, sure, sounds great. Okay, we're going to look at some calculations later as to why that actually makes sense. Okay, so purchase discount is actually initiated by the purchaser. It doesn't have anything to do with the seller. And that's kind of important to really get your head wrapped around there. Okay? Yes? No, that is not a purchase discount. Okay? We're talking about paying early, paying quick is typically what's going on there. All right? So let's take a look at these inventory purchases. Now again, if you went and you did your reading, a lot of this will be familiar. Okay? Because that's what we're actually looking at here. So Walmart receives $10,500 of bikes purchased on account, right? So we brought in inventory and we recorded accounts payable, right? So we analyzed the transaction and then we converted it into accounting format so that we could actually record that. So we've got $10,500 in inventory, $10,500 in accounts payable. All right. 10,500 of bikes were sold to Walmart. So now we're still talking about this previous purchase in the last slide with terms, what we call FOB shipping point. All right. Now let's stop right there and let's talk about what FOB shipping point means. FOB shipping point in this case, because we are the purchaser, means that, let's say that we bought these bikes, I don't think they ever tell us who we bought them from, but maybe Schwinn, right? We bought these bikes from Schwinn and we bought them FOB shipping point. So the shipping point would be Schwinn's dock. You with me? Okay. Now, so we bought them FOB shipping point, and we said, we're going to buy them for $10,500, and if you will, just set them right there on your dock. We're going to send somebody after them. Make sense? FOB shipping point, because we're the purchaser. Now, why, hopefully this will help this stick, why would Walmart do that? Possibly faster. You ever see Walmart trucks up and down the road? All the time, right? So Walmart, just like Amazon, by the way, Walmart, years and years and years ago, they would use a company like a FedEx or a UPS or Norfolk Southern or whoever it was that was shipping stuff during that time. Well, then they finally realized that it was like, you know what, we're moving so much product around and everything, it's actually cheaper for us to have our own fleet. So then they got trucks of their own and everything else and built warehouses all over the place, and just like Amazon did. Okay? All right? So then it says, these terms imply the buyer, Walmart, must pay the transportation cost of $200 to a trucker. All right, no problem. So, but watch what happens here. That $200 goes into inventory. So here's what you're looking for. So do I include it in inventory or not? The total cost that goes into inventory is all the cost that it takes to get that inventory to the shelf. You with me? So transportation from whoever we're buying it from to get it to our dock, that's inventory costs. And we may even have some additional inventory costs to get it to the shelf, because the customer still can't buy it back there in the warehouse. Yes, ma'am. It depends. Okay. So let's say that Walmart buys some product that is manufactured in China, right? But they need it here in Charlotte, right? Think about what that takes. One, we got a couple of options here. One, it's got to come from wherever the factory is. It's got to be trucked to the port. Then you got to go through customs. You got to pay tariffs and everything else right there before it leaves China. Then it finally leaves China. It gets on the ship, right? That ship comes across, and let's say it lands right there in Los Angeles. Okay? Now, they've got huge ports out there in California for all this stuff. Okay? They pull it off the ship. It goes through customs again. Then they put it on, they take that box, and if you ever see a shipping container ship, right, it just looks like a whole slew of those 18-wheeler truck beds, right, stacked one on top of the other. They take that thing, they throw it onto a truck, and that truck starts heading to Charlotte, okay? Probably takes another couple of days. Now there's more cost in transportation getting it out here, okay? Finally, it probably shows up at the Walmart distribution center that's right down the road here off of 77. They'll probably ship it there. Then Walmart picks it up from the distribution center, puts it on their truck, and then they ship it out to all the individual stores. Okay? So every bit of that, transportation, tariffs, and everything else goes into inventory. Okay? All right. So purchase returns and allowances. So let's take a look at this one. So Walmart returned some of the bikes to the supplier and received a $500 reduction in the balance owed. All right. Now, at that point, remember, it was sitting there in inventory, and we said, no, we're sending it back. At this point, we don't know why, okay? But we just remove it out of inventory, and we show that we owe the supplier less because we shipped them the product back, okay? All right. Purchase discounts. Again, remember, purchase discounts. It's not because of volume or anything else. That's just the standard negotiated price that they show us on the invoice. Purchase discounts is over and above this, and a lot of companies don't even do this anymore, but some do. Okay? But what we're looking at here is, what they're saying is that if, remember, we're the manufacturer, and we're saying if you will pay to the customer, if you will pay early or quick, we'll give you a little bit, knock off a little bit off the price. Okay? Now, in this one, this is the normal way that you read a discount. 2% net 30, 2% 30 days, net 60. So if you pay within 30 days of the invoice date, you can take a 2% discount. Otherwise, if you go to that 31st day, now you might as well just pay it in 60 days because that's when it's actually due. Okay? And there is no discount or anything that you can take at that point. Now, understand, that sounds like a small amount for a discount, but understand that 2% effectively per month means that is equivalent to a 24% interest rate for a year. You follow that? So 2% per month times 12 months is 24% interest that we're going to save because we're not asking the vendor to basically float us a loan. Okay? It would even be cheaper for us to have a line of credit where we're paying 6% interest per year. It would be cheaper for us to go ahead and borrow against that line of credit and pay this invoice off if they're offering discounts. Because the bank's only going to charge us 6% per year. These folks are going to charge us 24% per year. You follow? So, cheaper to borrow it. Okay? All right. Looking at sales transactions under perpetual. Now, understand, don't miss this. This is absolutely key. We just pivoted. That whole entire section that we just went through, we were purchasing the inventory. Now we have pivoted. That inventory is sitting on the shelf. And now we are talking about selling that inventory to the customer. All right? So don't miss that. All right, so let's take a look. Merchandisers record revenue when they fulfill their performance obligations by transferring control of goods to a customer either for cash or on credit. Okay? So again, we've got the whole FOB shipping point thing. Now, hopefully this is going to stick with you. Now, I'm going to use it because this is the one that I know. I like Macy's. Okay? I buy a fair amount of stuff from them. Not all, and rarely do I ever shop at the store because I don't like the store, but I like the products. Okay? So, when I am on my Macy's app, and they send me all kinds of coupons and everything else, so it's like every time I get a coupon or something, I'm like, do I need anything? So, I'm on my app, and I find something that I want. And they give me the option of, I don't know, maybe it's something small, $20. And they say, you can have it shipped to the store for free, and you can pick it up, or you can pay X number of dollars in shipping. You've seen this, right? Okay. So at that point, that's kind of what we're talking about here. All right. So if we're the seller, we're Macy's, and we are doing FOB shipping point, effectively what we've done there is you're Macy's and you ship the product to my home. Oh, excuse me. I just flipped on you there. Sorry. I'm getting the whole thing of you're the customer and everything else flipped. That's FOB destination. Because you're Macy's, you ship the product to my home. That's FOB destination. Okay? So you just shipped it out the door, and as soon as it lands on my doorstep, you record revenue. Because they got a delivery notification from FedEx, UPS, or whoever it was that shipped it. Right? Okay? If I go and pick it up at the store, okay, now it's effectively, you are Macy's, you just effectively flip that into a FOB shipping point because you said, I'll put it on effectively our dock at the Macy's store, right? And you can come after it. So now I take care of the transportation. Does that make sense? Okay. So the big thing to understand here is this. These two different kind of transportation, when we're selling, has a big influence on when we get to record the revenues being earned. If we're talking about FOB destination, you don't get to record the revenues being earned until it hits my front doorstep. If I choose to pick it up at the store, you don't get to record revenues until I pick it up. And it might take me a couple of days to get over there. You with me? Versus here, big difference. Now, think about, and I know that sounds like I'm nitpicking, but think about what happens when you're sitting there at the end of a fiscal year. Bunch of people are buying, and now they don't, but let's just say that they have a December 31 year end, right? And everybody, all the sales going on after Christmas and everything else. Do you want something sitting there that somebody's ordered? Do you want it sitting there at the customer service desk and you can't record revenue on that until they come and pick it up next year? No. You'd rather do this. So usually, if that was you, what would you do? Bingo. That's the reason why in all these different time periods throughout the year and everything else, they're sitting there going, hey, if you only buy $20, free shipping, for the next week. That's exactly the reason why they do that kind of stuff. Okay? So I'm hoping, again, my favorite compliment was, you're in my head all the time. So now I hope you're just paying attention to what's going on around you. Okay? All right. So every merchandise sale has two components, right? We just talked about this. We've got the revenue side of the component, which is how much we're receiving from the customer or earning. This time it happens to be in cash, or it could be not cash, but nope, accounts receivable. You with me? So it could be sales revenue and cash or sales revenue and accounts receivable. Okay, doesn't matter. It's all about when the customer got control of the item. Okay. Then the cost of that item gets removed out of inventory into cost of goods sold. So think about what's happening here. What's our gross profit? $100. Okay, but notice there's no gross profit account in here anywhere. Two different journal entries. Gross profit is a calculated number. Okay. All right. Walmart sells 4 mountain bikes at a selling price of $200 per bike for a total of $800 cash. The bikes had previously been recorded in Walmart's inventory at a cost of $175 per bike for a total cost of $700. So there's the whole entire thing that we just looked at, right? But it's 2 journal entries. Also, just realize that real world, when you're sitting there and someone is checking out your Walmart, and I'm the customer, I'm checking out, and it's beep, 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 beep. There's your 4 mountain bikes coming right out of inventory. And then when I swipe my credit card, whatever it might be, or hand you cash or whatever, it's like that's when you're recording the revenues. And all that's happening right there at the register. Okay? All right. Returns and allowances. So now we're talking about sales returns and allowances. Okay? Not previously we were talking about purchase returns and allowances. So hear me when I say this. Purchase returns and allowances are easy. Every single thing goes in and out of inventory and in and out of accounts payable. That one's easy. Okay? Watch what happens here. Okay? So now we're talking about sales returns. You sold the item to me, to the customer. Okay? But it arrived possibly damaged or otherwise unsatisfactory. The customer can, 1, return the item for a full refund. So think about what happens there. If I return it for a full refund, 1, I bring the inventory item back to you and you have to give me the money back, right? How many journal entries? Good. 2. 1, I brought the inventory back. So now you've got to take it back out of cost of goods sold and put it back into inventory, and you got to reverse that revenue. You with me? So if I bring product back for a refund, 2 journal entries. Okay? Now watch what happens in number 2. As the customer, I keep the item and ask for a reduction in the selling price called an allowance. Now let me give you an example of this one. So a couple of years ago, my washer died. Actually, it was my dryer. My dryer died. I'm weird. I like a nice matching set. But it doesn't have to be the extremely expensive ones. I actually usually buy commercial washers and dryers at my house. Then they last for about 20 or 25 years. But I bought this washer and dryer. This new washer and dryer, made the schedule for the delivery and everything else. Took like a half a day of waiting around, waiting for them to show up. Then they had to bring them, unpack them, get them into the house, set them up. You with me? So I'm like a half a day off from work. They get them all set in there and everything into the laundry room, and I go in there and I'm looking, and right on the top edge of the washing machine is a dent. And I look at the guy and I'm like, now in my head I'm thinking, I'm not that vain that I'm not going to worry about the dent. And the dent's still there, by the way. But am I going to take another half day off from work because of a dent? No. But I'm like, yeah, I'm not paying full price. Somehow you're going to have to get some kind of discount, call the office, whatever. But it's like, you're going to give me something off of this, because that's not a perfect washer. It's got a dent. So then they called into the office and gave me a discount on the cost of the washer. You with me? That's an allowance. I'm keeping the washer and the dryer, but you're earning less revenue. Okay? All right? So actual returns. So suppose that after Walmart sold the 4 mountain bikes, one of the mountain bikes was returned to Walmart in good condition. Now, up until this point, this is going to be the whole issue. Now, in this class, we're not going to talk about returns where something's damaged and all that kind of good stuff and get deep into that. That's a whole different thing, and that's intermediate accounting. Okay? Walmart would refund the $200 selling price to the customer and take the bike back into inventory. So 2 journal entries. Now, notice what happens though. We put $175. We take it directly out of cost of goods sold and put it back into inventory. So effectively reversing the exact journal entry that we had when we sold it. Okay? But watch what happens up here with the revenues. We refund, in this case, you gave me $200 cash back. But notice what happens here. We do not put that against sales revenue. We put it against a contra revenue account called sales returns and allowances. Because in the accounting department, we want to know how much is coming back from returns. You with me? Now, have you ever bought something where, like online, and you get the box in the mail and everything, you open up the box, and there's that like invoice sheet in there that tells you, you know, like what it was, what'd you buy, how many, and all that kind of stuff and everything. You ever turn that sheet over? Okay. If you turn that sheet over, there's usually like 52 reasons why you're returning the item. Was it the wrong color? Was it too small? Was it too large? You with me? Is that sounding familiar at all? A lot of times, if you do, yeah, turn that sheet over. There's usually like a whole thing on the back of that invoice that says how to process a return, and then there's a whole little return thing that says how many are you returning, what is it, why are you returning it, and literally there's like 20 or 25 reasons why you're returning it. You know, is it damaged? Was it just the wrong color? Because again, that's things that we track in the accounting department for one reason. Think about this. Let's say that we put out, I don't know, let's say that we were a clothing manufacturer. And let's say that we put out a catalog. And, you know, this particular catalog, everybody keeps ordering this one item. And this one item keeps coming back to us. And the reason why it keeps coming back, the box that's checked, is color was incorrect or something like that. And it's like, okay, but that's like 25-30% of the people are returning this thing, and they're saying that the color's not right. What would you check first? I know what I would do. Not necessarily. What was it? Well, imagine that it's like a shirt or a pair of pants. I guess it could be ripped, but no, there's nothing wrong with it. But they keep returning it, saying it was the wrong color.
Whatever automated system that they're using to check what the actual item is wrong.
Okay. There would be a possibility. So maybe our computer system got messed up, and maybe the light blue item is in the dark blue bin. So every time somebody keeps pulling something, they're pulling it from the wrong bin, and it's the wrong color. But there's another one that's maybe a little bit more obvious, did the color render correctly in the catalog, or did it render correctly on the website? Because everybody's thinking it's navy blue, but then when they get it, it's more like a blue-green or something like that. You with me? So that's some of the kind of stuff that we help. Accountants do a lot more stuff than just ticking and tying numbers and stuff like that. Because if we've got a return problem, we're now working with manufacturing or something like that. Now, other things that could have happened too is that maybe the supplier got the color wrong. Maybe they packaged it incorrectly when they sent it to us. So that's some of the things that we do as accountants, that we're problem solvers. We help fix stuff, which I think is actually some of the more fun things that we do. All right. Expected returns. Oh, hang on a minute. Oh, it's 2:47. All right. Let's take a break. Let's be back in here at 3:03.